Center. We are a New York State agency that works exclusively with small businesses. We've been very active in these COVID-19 times, helping people secure funding, giving people some insight into the various programs that exist, the funding opportunities that exist. Things have started to dry up a little bit, but we're hoping for a little bit of change of heart in Congress as far as putting some more money into the system. Since we began working with folks on COVID-19 issues back in March, we've accounted for over $13 million worth of loans. So we have a pretty good idea of what you need to do to qualify for these things. I mention this because we believe there's going to be another round coming up soon. And if you're looking forward to getting any of the additional funds that might be available, or if you're looking to maybe update your business plan, maybe secure some additional marketing insights, we'll be able to help you out with that. The price is right for what we do. I used to tell people it's free because that's what it is, but my wife tells me there's no real value in free, so I tell people now it's prepaid. You've all prepaid for our services. It's your tax dollars at work. You should take advantage of it. We are obviously working via Zoom sessions, and certainly the telephone, email, one-to-one sessions have been curtailed because of the COVID situation, but we're hoping to get back into the saddle as well. We'll work with you for as long as we're all doing something constructive, and all that means is if you call us after today's session and say, gee, I need to contact for the presenter, we can certainly do that for you. If you're saying, gee, I need some help with a business plan, we can certainly work with you on that, and we'll work with you for as long as it takes to get it done. We have an excellent program called EntreSkills, which is an online business plan development program. It works at your pace. You're assigned to an advisor. The advisor will work with you on making sure that you have crossed all the T's and dotted all the I's. So having said all that, you're not here to listen to commercials. I'll post our contact information, the website where you can schedule appointments, phone number where you can reach us at, and you can check that out in the chat section as well. And so I'll hand the floor over to Tim right now. Tim.
Yes, good morning. Thanks, Jan. Good morning, everybody. My name is Tim Bach. I'm a business advisor with the Small Business Development Center. I'm pleased to introduce today's speaker, Jim Swick, CPA. He's a tax partner with Allied Financial Partners. He presented last year. It was very well received. Certainly have a timely and important subject for you today, year-end tax planning. This is kind of part one of a part two series. Next month, Jim and someone else from his office, Linda, are going to be presenting on starting your year off right. So please join us for that one as well. Other than that, Jim, the floor is yours.
Great. Thank you, everybody, for logging in today. This is definitely a little bit different than last year. Obviously, most of us probably prefer the in-person presentation. I just find that it goes smoother. It's right now I'm sitting here staring at a picture of myself, which is just weird. I like to see everybody else's faces. Of course, that's not possible because of COVID, but that's all right. We'll make do with this. But as I think Kate mentioned, she's going to keep everybody muted. But if you have a question, and I'm hoping you guys do, shoot it into her through the chat, and then she'll interrupt me, and then we could kind of go over the questions as they come in. Don't wait till the end. Let's just get these questions taken care of. I find that the presentation then is more valuable if we can answer the questions as they arise. So I guess I'll explain my backdrop too. So I'm in our Buffalo office today. I don't have one of those fancy backdrops set up here. And our conference room was taken. So I'm in their old IT room. If you see all the old monitors and everything like that, that's what that's all about. So not the prettiest backdrop, but that's okay. All right. I'm going to share the screen here and we'll start going through the presentation. Let's share that. Hoping everybody can see this. If you can't see it, let me know. This is the PowerPoint that I put together. So year-end tax planning and the CARES Act. So in a year like this one, as we all know, an abnormal year, COVID-19 has done a lot of different things to small businesses. Okay, some businesses have thrived. Pizza shops have had probably record years in sales and everything else. And then there's other businesses. A lot of the ones that we've seen, our restaurant clients, are really suffering. Either way, this is a really important, these are really important reasons to plan for it for taxes. Whether you're way ahead or way behind, you always want to look to see what you're going to owe potentially, and if there's any ways that you can change that. It's, you know, right now it's the beginning of December. There's still time to do things to affect your tax bill. So we'll get into that a little bit, and then the CARES Act, which is probably where we'll get a lot of questions. So if you don't know what the CARES Act is, it's the stimulus, the little $2 trillion bill that was passed, and you know, it includes the stimulus checks, it includes the PPP money, and some other things that we'll get into. You know, big effects on small businesses. So we'll cover some of that stuff here today. All right, let's get into it. So first, how do I switch this on a PDF? Okay, here we go. All right, first I want to introduce our firm. So firm name is Allied Financial Partners. We are headquartered in Rochester, New York, but we have 5 different locations across the state. As I mentioned, I'm in Buffalo today. We have Oneonta, Perry, at Cooperstown, and yeah, Buffalo. So all in all, we have about 21 CPAs on staff and 65 total employees. We also, so we're a CPA firm, we're a financial planning firm, and we're a payroll firm. We offer basically all services that touch small businesses' financial life. We cover in-house under the same roof. So we have 3 CFPs on staff, which they'll help you with your 401k, setting up IRAs, etc. Full service, full financial plans for individuals. Payroll department, obviously small businesses that run payroll need that. And then the CPA side, which we do audited financial statements. We do cost segregation studies, valuations, tax returns for corps, partnerships, 1040s, everything that a CPA firm would do, we do. So yeah, our aim is to be that one-stop shop for small businesses. Oops, I'm jumping around here. A little bit about me. So I'm originally from the Buffalo area. I joke around and say, when I was in high school, I was a pole vaulter. So I went to Rochester 3 times a week to train for pole vaulting with Rick Scher. He's actually Jen Scher. She's the Olympian pole vaulter coach. And now I am in Rochester because I met my Italian wife there, and I travel to Buffalo 3 times a week. So I kind of made the switch here. I went to Roberts Wesleyan College, graduated in 2008. I have 12 years of accounting experience, 10 in public accounting, mainly in the tax side, and then 2 as a controller in a real estate company here locally. And my wife, Donna, father to 2 sons, Braden and Nathan. They are 5 and 4 years old. So I definitely got my hands full when I'm outside of the office. All right, so we will get into the material here. Forgive me, I'm not used to talking so much. I'm usually sitting behind a computer, so I have to keep hydrating here. All right, finishing up 2020 right. This all plays into the tax planning. Okay, so you want to make sure that now, if you haven't even looked at your books, which I know a lot of small businesses haven't, you want to start tidying up things for 2020 for your tax filings. Okay, so you want to go through your bank statements, and it depends on what you do for bookkeeping. Do you do an Excel sheet? If you do, that's fine, but make sure that you start getting everything in. If your business is big enough to do something like QuickBooks, great, but get in there and start reconciling things. And really, you want to try to set something to get yourself on the right track here going forward. So let's say you got to catch up now. Just try to get it set up so you're looking at it monthly. Okay, so you set up your monthly time when your bank statement comes in, and sit down that Saturday for an hour or 2, go through it. It's just a lot easier to do regularly than catching up. We have a lot of small business clients that wait until the last minute. The problem with that is you have no idea where you are. It's December now. You have some time here before the end of the year that you could change things. If you don't have your records together, you won't know where you are, and you won't know if you need to make a purchase before the end of the year. So yeah, now's the time. If you've procrastinated, and I know all small business owners wear multiple hats, okay? But now is the time to catch up and make sure that you know where you are. That's the first part of tax planning. So as I said, reconcile your cash and credit card accounts. And what I mean by reconcile is sit down and go through them, right? Go through your bank statement and make sure that you're accounting for everything on your bank statement into your books. You want to make sure that you're not missing any revenue, you're not missing any expenses that you've earned. So you want to go through and check those things off as you do it. And if you're in QuickBooks, there's actually reconciliation screens that you can click in QuickBooks to make sure you're not doubling things up. And that should be part of your monthly process. And I think Linda's going to address that next month in the next webinar here. She'll go more in depth on how to do that, but definitely time to catch up now. Review your reports to see if it makes sense. So a lot of small business owners will judge where they're at based on their cash. How much cash do I have in my account? That's not necessarily the best way to do it. So after you go through your records for the year, take a look at it and see if it makes sense. If it says you have a profit of $100,000, does that make sense to you? And then, of course, if you're in QuickBooks, you could look at your profit and loss statement and your balance sheet. I know a lot of you guys probably, and a lot of our clients are actually they do things in Excel. It could be easier. Maybe they don't have a ton of transactions, so they may not have those reports. But if you do, those are the reports that you could run. This is probably getting a little ahead of ourselves, but request a business organizer or list of items needed by your accountant. That's more for after December. Okay, so when you're getting towards the end of December or maybe in early January, that's when you want to ask for that organizer to see what documents you could put together that they need to get it into them early so they could get your return prepared. Okay, continuing along here, there's some year-end filings that you need to get in pretty soon. That's why we want to make sure that you're ready. So 1099s, this is the first thing here. These are due January 31st. And I'll just kind of explain what 1099s are. Some small business owners may not know. If you are paying vendors for a service and you pay them over $600 and the vendor is not incorporated, you need to send them a tax document. And you need to get that in the mail by January 31st. So if your books aren't ready, if you aren't staying, up to date with your record keeping, it's a scramble in January to try to get the whole year done and figure out who you need to send these things to. Also, you need to send payments to attorneys, no matter what. You always have to send the attorney payment. And then new this year, which is kind of a weird wrinkle that they just jammed in here, was this 1099 NEC thing. So it used to be you had one 1099 miscellaneous, it was called. And these payments that you made to the vendors for services, you would enter into box 7 on 1099 miscellaneous. And let me back up though. What do I mean by paying a vendor for a service? So basically, let's say you had Joe's Landscaping Company, and Joe came and he did $2,000 worth of work at your business, and at the end of the year, you'd have to send him a 1099. So why does the IRS do that? Because they want to make sure that Joe is picking that up on his tax return. That's why. But now, instead of sending him a 1099 miscellaneous, you'd send him this 1099 NEC. So you would still use the 1099 miscellaneous for, if you send out prizes or other things, you just fit them in like box 3 and just follow the instructions on the 1099s. Okay, so I mentioned that the IRS wants to make sure that people are picking up their income, right? So let's say you think to yourself, well, Joe is a nice guy. I don't want to send him this. I don't want to send out this 1099 and send it into the IRS because I don't want him to have to pay tax if he doesn't want to on it, whatever. There's fines if you miss them. So you got to make sure that you're keeping track of all these vendors. Otherwise, you could get dinged up to $500 per missed 1099. That's why it's so important for you to fill out and send these in. I've never seen this actually happen, but the threat's there. And then let's say you send that 1099 out to Joe, and you, or you as a business owner, let's say you get these 1099s in. If you're not incorporated, you got to make sure that you're claiming all this stuff. If you don't, the IRS will send you a little love letter in the mail and say, hey, you know, this so-and-so, we got notification from a third party that they paid you this much money, basically, and why isn't that on your return? So you got to make sure that all these 1099s that you're receiving your income is at least higher than those.
Hey, Jim, can I interrupt you? We've got a couple questions.
Yep.
Okay, the first one is, do you need to send a 1099 if the business is incorporated? And the second one, how do they find out you missed one?
Yeah. So if the business is incorporated, then no, you do not need to. Best practice is to, before you pay your vendor, send out a W-9 to them. So then they have to fill that out. They give you their identifying number, their EIN. They check a box that tells you how they're taxed, and then they send you their address and everything. So that's all the information that you need. The incentive for them to send that to you is you say, I'm not paying you until you fill this out. So once they fill that out, they send it to you, you have it on file. And yeah, if it's checked incorporated, you don't need to send them one, but it doesn't hurt to send them one. That's something to remember. You can send corporations a 1099. It doesn't harm you. Better safe than sorry, we say. You know, sometimes clients send them to people that are incorporated that they don't know that they are, and there's no harm. So better safe than sorry, send it out. If you're unsure if they're incorporated or not. And then how do they tell if you filed them or not? Well, there's something on your corporate tax return, at least, that asks you, there's a question. Did you pay vendors over $600 for the year that should have received the 1099, and did they send out 1099? So it's kind of like the red flag, right? So you have to answer it, you know, yes, you did, and yes, you sent it out. If you say yes, you paid vendors, and no, I didn't send it out, you're probably gonna get looked at. That's a red flag, right? The other way that they'd find it is if they audit you. You know, and audits are few and far between these days, but there's always that risk. And then lastly, on 1099s, there's a $50 fee, late fee for filing after January 31st. So there's a threat of that. It's just more of the reason to keep your books up to date. Payroll reports. So this, I'm hoping that most small business owners, if you run payroll, you outsource it, because I'm not saying that because we offer payroll services. There's Paychecks, there's ADP, there's plenty of people that do it. But the payroll laws are complicated and the penalties are stiff. So you want to make sure that if you're doing it yourself, you file everything on time. Your quarterly filing reports, the ones for December are due by January 31st. That includes W-2s. That includes your 940, your quarterly 941, and in your New York State 45. If you've hired a payroll company to take care of this for you, they will be filing these reports, and it's something that you don't need to worry about. But if it's something that you try to do yourself, I know you can do it through QuickBooks. I think they offer a payroll thing. There's some other things that allow you to do it yourself. Just make sure that you're aware of that deadline. Okay, this is kind of continuing here, finishing off right. Make sure that you're adjusting journal entries. That's what AGEs provided by your accountant. Make sure that they're posted. And this really only applies to people that are QuickBooks or you're actually using an accounting software. So the way this usually works is small businesses will send in their information. Your accountant will make journal entries. Then they file your tax return based on the corrected reports. A lot of times, I work with small businesses all the time, so we see people wearing the multiple hats, and they're not always the best bookkeepers. So we make journal entries and then file their return, and then we send the client the journal entries. If you're not posting these journal entries, your books will never make sense to you. So you'll look at your cash accounts. You look at your loan balances, things like that. And, you know, if you run a balance sheet, it won't make any sense. If you post the entries, it'll make sense, and it'll make the tax filing go smoother. So maybe if you're incurring large fees from your accountant, maybe this could save you fees. Another big one that we see small businesses do, and again, this is QuickBooks. So if you're in Excel, just kind of ignore this for now, but when the year is closed in QuickBooks, we have a lot of small clients that they'll post entries to the prior year. You don't want to do that because the tax return's already filed for that year. So any changes that you make, you want to make in the current year. And I know like people will post accounts receivable, which means, you know, a list of people that owe me money. That's my accounts receivable. If they can't collect that, they'll go in there and they'll just delete it, which that'll change the prior year if you entered it in the prior year. So there's ways that you can stop yourself from doing that. There's, you know, you could password protect closed years, and it'll just make sure that, again, you know, when you get, things will make sense for one. And when you get this into your accountant to file your corporate tax return or whatever tax return, things are cleaner and could go, you know, your fees could be potentially decreased because it takes less time to figure things out. Okay, so we got through the ending the year off right, or wrapping up the year, whatever, which is the first important step here for tax planning. You got to know where you are in order to plan. So now we still have, you know, roughly 30 days. We have a month here to take action. So what can we do? There's a few different options, right? But the one thing that I always preach to clients here, we do as a firm, you don't want to just buy something just to buy it. A lot of people hate paying taxes. They'd rather pay anything, you know, than pay taxes. But it's very important to preserve your capital unless you're using it for something that you need. Okay, so if you need a new piece of equipment, if you need a new truck, then yes, go ahead and buy it before the end of the year, and you could take accelerated depreciation on it to get yourself out of some tax, depending on where you are. But if you don't need it, then, you know, maybe there's some other options out there. Retirement accounts. Do you have a retirement plan set up for your company? And is it the right one? There's plenty of different retirement accounts out there that you can do. Some you could put away a lot more pre-tax dollars than others. So I would recommend, if you're in a situation where you think your tax bill is going to be pretty high and you're working with your accountant to figure that out, maybe you want to look into a retirement account. There's ones that are simple and low cost, like simple IRAs. There's, you know, more advanced things like 401ks with profit sharing. But it's something that you're going to want to get kind of a financial advisor person on your professional team here to help you, you know, and you work together with them and your accountant to figure out, okay, how much are we going to be able to put into this retirement account? How much will that save me in tax dollars? You got to look at it as a full picture. And then the last item I have on this page is accounts payable. So what do I mean by that? So as a business, you can file in a couple different ways. Generally speaking, we'll keep this pretty basic. You have accrual basis and you have cash basis. So what do those mean? Well, accrual basis means you file based on, and you file and you pay tax based on money that you're owed and money, but then you get a write-off for money that you owe people. Okay, so if you bill out, let's say $100,000 in December, but you haven't been paid on it yet. Let's say they pay you in March of the following year. If your accrual basis, you're paying tax on that $100,000. If your cash basis, basically, you pay tax on money that you have received, but you get a write-off for money that you've paid out. Okay, so most small businesses benefit from being cash basis. If you're a small business, a lot of you guys probably know, you know, especially if you're working with bigger companies, if they're your customers, okay, some of them take 60, 90, 120 days to pay you. And as a small business, that's not easy, right? You need that flow, you need that cash in. And the last thing you want to do is pay tax on that. So that's why it's pretty important to know the difference there. And most of you should be cash basis. If you're not cash basis at this point, there's actually an opportunity under the TCJA, which is the Trump tax law, that allows you to convert to cash basis. And it's something that you may want to discuss with your accountant. If you look at your tax return from last year, and this is mainly applying to separate entities. So if you're an S Corp, if you're a partnership, if you look at your return and it says the box is checked for accrual, it's possible that you can convert to cash basis. And I'd bring that up with your accountant. If your receivables are higher than your payables, you get a 1-year write-off for that, based on the new law. Well, not new anymore, a couple of years old. And there's still an opportunity to do that. Now back to my point here on accounts payable. A tax planning technique is, if you're a cash basis taxpayer, you have the opportunity to take a look at, you have your list. A lot of people have a folder, who I owe money to. Okay. So I owe money for this and that. You go through your folder. If you have the cash, you can actually pay down those payables, even if they're not due until January. You pay them, and then you get that write-off in 2020. So that's an option.
Hey, Jim.
Yep.
Just one more either question or point says that I heard that the IRS frowns on cash basis. Not true?
Not true. The IRS just tries to govern, the tax law, but under the new tax law, they have it's a $25 million revenue cap for converting to cash basis. They actually, the law favors cash basis for small business taxpayers because they understand the fact that it's more of an advantage. It used to be lower, but I'm guessing if you're sitting here in this meeting, most of you probably have under $25 million in revenue. So no, the IRS does not frown upon cash basis. In fact, it's probably the opposite for small businesses. They understand it's an advantage, and they, maybe not the IRS encourages it, but the tax law encourages people to be cash basis.
There's another one that says, can you get an accountant at Allied?
Can you get an accountant? Yes. We could talk after if you're interested. You could shoot me an email or something and we can discuss it. But yeah, for sure.
Perfect. Thank you.
Mm-hmm. Okay, tax planning continued here. So I mentioned purchasing equipment, purchasing vehicles. And really, I talk about purchasing trucks, okay? Because trucks are the best bang for your buck depreciation wise. As long as it meets certain specific standards, like it's over, I think it's like 6,000 pounds and it has a truck bed of 6x6. I don't know what the measurements are, something like that. You could write off the entire truck in 2020 if you buy it. Same with equipment. Contractor, if you want to buy, well, I've really had my eyes on this new backhoe, and I'm going to owe a bunch of tax. I think I want to buy it before the end of the year. You could buy that piece of equipment and you could take Section 179 this year and write it all off in 2020. That's the beauty of this Section 179. That's why we say it's so important to know where you're at in December, because you could still make moves now and save yourself some tax. And another point that I want to add in here, you don't have to buy it in cash. You could finance this stuff and still take the write-off. One of the drawbacks of this is if you buy it now, you finance it, you take all the depreciation this year, you're still paying off that loan, which, your capital is going to pay off this loan, and maybe you have another tax situation next year and you don't have the cash to cover it. So that's one thing that you got to be careful about. But, it's a very powerful option to buy stuff that you need and take the write-off before the end of the year. Real estate. So this is a new one, and this is about as exciting as it gets in the accounting world for us. You can actually take Section 179 on certain real estate things now. And this has got to be commercial property, can't be residential. I know I personally have a lot of smaller time real estate investor clients that own residential houses. I own some myself. seems like they always pick on us. They don't let us take these deductions. But it's pretty cool that you can actually now put a new roof on your commercial building, and you could take Section 179 on that and write it all off this year. Same thing with HVAC, security system, and fire protection system. So it's another option. If it's at the end of the year, you got to save some money. You needed a new roof anyways. Let's get that in by the end of the year, place it in service, and we could write all that off this year and save you some taxes. Bonus depreciation. This is kind of similar to Section 179. So remember, Section 179, I said you could write it all off this year. You could do that for federal, and you can do that for New York State, Section 179. But you can't take it below zero, Section 179. For bonus depreciation, you can take it below zero, but you got to be careful because New York State does not follow the IRS with bonus depreciation. So you have an add back on your New York State tax, and then sometimes you end up owing tax on New York State, but not federal. Again, it's another planning thing. I wouldn't expect any small business to look at this and figure this out. This is something that you should go over with your accountant. Actually, you probably don't even need to go over it with them. This is something that they would figure out for you. But in different situations, sometimes it makes sense to take bonus depreciation. If you're a farmer, maybe you want to do bonus depreciation because you get the investment tax credit. Same with manufacturer. So I know that one's kind of missed sometimes there with accountants. So if you fit into those industries, I'd ask about the investment tax credit and bonus depreciation with your accountant.
Can I stop you there?
Yep.
You've got one. Do capital expenditures count under 179?
It depends on the capital expenditure. But yeah. So like I was saying, equipment, let's say you buy $100,000 piece of equipment that would normally be CapEx. You can write that off. Yes, 179 it for sure. And also parts of commercial buildings. So this bonus depreciation that I want to get into that is new, quote unquote new. It was intended in the law, but it was screwed up when they wrote the law because they always jam these things in at the last second and they always screw it up. But they fixed it. So all property that has useful life of 20 years or less you could take bonus depreciation on it. So why is this important? If there's any real estate people in this chat or out there, you can actually, as long as it's commercial real estate, you could do cost segregation studies on your commercial building, and which is basically when you buy a building, generally speaking, it's depreciated over 39 years for a commercial building. That's a long time to get depreciation every year. You're not really getting much of a write-off for that. This bonus depreciation now allows you to take this building, you get a cost segregation study, and it separates this building into different property. So let's say you buy $1 million building. A cost segregation study, the accountants go in there and they figure out, okay, well, they go through the building, you look at carpeting, you look at walls, decorative things, and you say, all right, 10% of this stuff is five-year property, 15% of this stuff is 15-year property. So then you're looking at 20% or $200,000 of this building is now eligible for bonus depreciation, which is huge, especially for real estate developers, people that buy a lot of commercial real estate. You can do all these cost segregation studies and actually you take bonus depreciation, you could take a lot of them could take their income all the way below zero. And then you could take an NOL loss carryback, which I'll get into. And NOL means net operating loss. So you could take a carryback then, which I'll get into. Qualified improvement property. This is another thing that falls into it's 15-year property. So another tax planning potential option here. If you're a business owner, you own the building. A lot of our clients will own the building and then they lease, they rent it back to themselves. You could improve the interior of your building and then just take that bonus depreciation on it, or actually you could Section 179 it. So that's another option that you can do. Okay, this is a kind of a complex one here. So you want to maximize your qualified business income deduction. So we don't think that there will be many tax changes. I know the president has changed or will change. We think he will change. But that being said, we were worried at first that this QBI, qualified business income, could potentially go away because this is such a huge savings for small business taxpayers. This is that, I don't know if you guys remember the 20% deduction that you automatically get, generally speaking, okay, unless you're a specified service trade or business. So what does that mean? That means that let's say you make $100,000 in your business. Right out of the gate, you get $20,000 deduction, which is great for small businesses. It benefits them substantially. So what do I mean by maximize your qualified business income deduction? There's ways that you can make sure that you're taking more of this by decreasing your wages, but you got to be careful, okay? Because your wages, the IRS wants you to have a reasonable compensation, it's called. So if you are, let's say you're a business owner, let's say you own a pizza shop, and you really, your job description is basically you manage this. So what could you hire somebody to do your job for? Generally, we look for like comps. It's almost like you're selling a house, like comps. So I go on Glassdoor and I find jobs that are paying what you do, and I find 3 of them. I say, okay, there's your reasonable compensation. The rest you can take. The rest of your compensation that you want to pull out, you take in S corp distributions, or partnership, just distributions instead of salary. And then you get the rest of this qualified. You get the rest of that money in qualified business income deduction. You get 20% on the difference. So by lowering your income to a reasonable compensation, you get more of this 20% deduction. It's a little bit complex, but it's something that maybe you want to talk to your accountant about. And it's pretty much too late for that in 2020, but in 2021, it's something that maybe you should look to. Okay, farmers, manufacturers, mining. If any of you fall in that category, as I mentioned before with what was I talking about before? Bonus depreciation. The farmers have probably the best lobbyists in the world when it comes to tax law. You have so many different credits available for you. So a big planning point for me is just make sure that you're taking advantage of all these New York State credits. There is the farmers real estate tax credit. There is the manufacturer's real estate tax credit. And for farmers, you own a lot of land. All the taxes that you pay on that land, there's credits available for that. There's other things too. There's wage credits available for farm laborers. So just make sure that if you have an accountant, they're aware of these different credits that are available. And then another one for farmers is there's a huge tax planning opportunity, because if you just have a farm on your Schedule F on your tax return, it's subject to self-employment tax, which is a tax that people don't expect. Basically, it's the FICA and Medicare tax that if you're an employee, you get it withheld every paycheck, and the employer pays the other half of that. You never even see it. When you become self-employed, this is a big surprise for people. So there's an opportunity for farmers to buy seed or buy other farming products, I guess I'll say, up to 50% of your revenue. So you can prepay and buy all this stuff, decrease your Schedule F for 2020, and you get out of not only income tax, but self-employment tax. So there's a lot more opportunities for farms. And lastly, entity type. So do you currently have the correct entity set up for you? Like, what works best for you? Are you an LLC? Okay, well, an LLC can be taxed in multiple ways. Should you be an S corporation? It depends on the situation. So just make sure that you're in communications with your accountant about that, but there's definitely tax advantages depending on where you're at. And that's a question that I get all the time. Should I be an LLC? should I be an S corporation? Generally, I say around when you're around $80,000 in profit, it makes sense to switch to an S corporation. And basically, when you're an S corporation, you take a reasonable compensation, you take the rest in distributions, and you can kind of save some of that self-employment tax. A lot of business owners like saving that up front. Maybe you end up losing some in Social Security in the back end, but most business owners prefer to get the tax savings up front. Okay. So that's what I got for tax planning. If anybody has any questions on any of that stuff or a different question, feel free to shoot a question in. But
Yep, we've got one actually.
okay.
Can past taxes be gone over to see if things were missed and then resubmit the taxes?
Yes, you have 3 years from the date of filing to amend your return. So if you want to go over that, you could review your return. If you miss something, you could always go back and amend it up to 3 years. Okay, so we're going to get into the CARES Act. And again, the CARES Act is that $2 billion stimulus package. Okay. And maybe there's going to be another one of these. We don't know. Last I saw, they were talking about a $1 billion one. I guess we'll see. But for this one, it's kind of broken up into a few important things that I want to go over. There's the stimulus checks that everybody knows about. If you don't, then you must have been living under a rock. This is that $1,200 payment that people were receiving per taxpayer and spouse, and then $500 additional for qualifying dependents. So we'll go over that. IRA distributions. There's some things that can help you if you took money out from your retirement, or not just IRA, but retirement distributions. Let's say you took it out because you needed money because of coronavirus. There's some things we got to go over for that. There's some other things that were stuffed into this CARES Act that we'll go over. And then last but not least, the Payroll Protection Program, the PPP, is what it's referred to as, and the EIDL, which is, I forget what that stands for. I think I have it written down in my in my slide, but we'll go over that too. Okay, so the stimulus checks, as I kind of stated earlier here, what is this? This is the $1,200 per person, $500 additional for dependents. The big thing that we were getting questions on, or one of the big things was, well, I have a dependent, but I didn't get it for that dependent. It could be because your dependent's over the age of 17, which kind of mirrors the child tax credit on your tax return. As soon as your kid's over 17, he or she didn't qualify. They didn't qualify for that $500. Income phase out. This plays a big role, and it's kind of a little bit of a complex situation. But if you're single and you made more than $99,000, you weren't eligible for any of it. Head of household, it was $136,500, and married filing joint, if you made over $198,000, you wouldn't have received any stimulus. And also something that I didn't know until I took my CPE here recently, continuing ed that we take every year. Your income phase out increased by $10,000 for each qualifying dependent that you had. So let's say you're married filing joint and you had a kid. Instead of $198,000, it would be a $208,000 when you wouldn't receive anything. Eligibility. Who is eligible for this? Basically everyone except your non-resident aliens. If you're a dependent of another person. So this is a big one for college kids. A lot of them were bent out of shape about this. Okay, so they wanted their $1,200, but their parents claimed them on their return, so they didn't get their $1,200. So they weren't eligible. And then estates and trusts, that's kind of just an obvious one that they wouldn't qualify. But one thing that we do know is recent college grads. You may actually be eligible when you file your 2020 tax return. So you didn't receive, let's say you're graduating in May of 2021. I'm sorry, let's say you graduated in May of 2020. you didn't receive your advanced stimulus check because you were dependent on your parents' return last year. If you file and claim yourself in 2020, you're going to get your $1,200 credit then. And this is something that if you're in this situation, you should bring it up with your tax preparer, because the parent may not necessarily get as big of a benefit from that child, claiming them in their last year of college as a child would. You know, the child gets the $1,200 credit now, the parent would only get a $500 credit. And usually there's no education credit in that last year because the tuition was paid the previous year. So if you're in this situation, definitely bring it up to the accountant, have them optimize what makes the most sense for us. You know, like I said, the parent would only get 500, 12, and the kid would get 1,200. So the difference there can be decently substantial. You're looking at what, $700 difference in refunds. So something that you want to bring up for sure. What else do I have on this? Okay, so how does this stimulus work? This was a big question mark, and I received a ton of questions on this when this first happened. And maybe they're all ironed out now, but I'll bring it up anyways. And I apologize. I know this isn't small business related, but it's personal tax related, and we all care about personal taxes anyways. So, will I have to pay back this money? And the answer is no. Okay, it's an advanced credit. So how this works, let's say that you received the $1,200. And I don't know if you guys are familiar with the child tax credit. It's $2,000 per kid. The way that works, generally speaking, let's say you had taxable income of $20,000. You had tax of $2,000. You didn't pay any money in withholdings, but you had one child. That $2,000 credit reduces that tax dollar for dollar, so you would owe no tax. In this situation, let's say you got that $1,200 check. That's another credit. So you would have the $1,200 there. If you didn't receive the stimulus advance credit, you'd get it on your tax return. But if you did, it would just offset that. So net at zero. You wouldn't have to pay it back. Something else that I want to kind of go over quick is there's all these different scenarios that we run into now. Okay. So let's go back to this income phase out just because I don't remember it off the top of my head. But let's say that a single person made $50,000 in 2008 and 2009, and they got the $1,200 check advance credit in May. Okay. Now let's say that same person made 200 grand in 2020. They actually would not have to pay that advance credit back, even though they received it. So that's kind of nice for them. They lucked out. But there's a situation where maybe they didn't luck out. So let's say that there's a single taxpayer that received, that didn't receive this. Actually, okay, let me go to this scenario. Single taxpayer made $200,000 in 18, $200,000 in 19, did not receive this advance credit. Then they would actually get that on their tax return when they file the return. So if they made under the income threshold, so let's say they had a bad year because of COVID, they made $60,000, they actually get that $1,200 credit on their tax return. And there was another scenario in there that if I remember it, I'll bring it up as I go on here. Okay, here's a big one. Don't try to pull a fast one when you're filing your return. We, as accountants, we need to reconcile these things on your tax return. So if it says you're eligible for advance credit of $1,200, or no matter what it says, you got to tell me what you received. If you don't, you're not going to get more of a refund. The IRS knows. They have a database of all the stimulus money that they paid out. It'll, best case scenario is it just delays your refund. So you want to give your accountant the amount that you received. If you receive too much based on your income in the current year, you're not going to have to repay it. So just give your accountant the amount of money that you received so they could put it on the tax return and everything goes smoothly. Otherwise, you're just going to get a notice from the IRS that says, we changed your refund. We have record that you received this. when you reported 0 on your tax return. It'll be treated as a calculation error and they'll just kick you out a different refund amount, but it'll probably delay it. Here's one that I've run into this year. So what about if you received the stimulus check for somebody who died? So I had a client that, they were married in 2019. The wife actually ended up passing away this year before all this stuff. And he received a $1,200 check for him and a $1,200 check for her. So he received $2,400 total. Doesn't have to pay that back. What about a divorce situation? So here's a scenario, which we're going to run into. Maybe some of you are in it. Let me just get my calculator up here. So let's say a husband and wife have 3 kids and they qualified for this advanced stimulus based on their 2019 filing. They received $1,200 for the husband. They received $1,200 for the wife, and they received $1,500 for the 3 kids. It's $3,900 total. But they were divorced in 2020. They're going to file separately. Okay, so how does this work? So you would have a scenario where, and all divorce agreements are different. Usually you split up the kids based on odd or even years, whatever. But let's say in this scenario, the husband has the right to claim the kids in 2020. So you take this $3,900 divided by 2, that gives you $1,950. When the husband files his return, assuming he fits in the income limitations, he would get $1,200 for himself, $500 for each kid. That's $2,700. And his tax return would show that he only received $1,950 because we split the $3,900 in 2. So he would actually get $750 additional stimulus money when he files his return. Meanwhile, the spouse, her return would show that she received $1,950, but she would only be eligible for $1,200 for herself because she's not claiming her kids. So there's a gap there of $750. In her case, she doesn't have to worry about it. She doesn't have to pay back the $750, so she'll be fine too. But the husband does end up getting more. IRA retirement distributions. This one could apply to some of you. So in the past, if you pulled money out of your retirement account before you're 59 and a half years old, you get dinged, generally speaking, with a 10% penalty on top of the income tax that you would owe on it. And that's something that a lot of people don't expect. They work with their financial advisor. They get the money distributed to them and they say, well, I have 10% withheld. Okay, well, you forgot about income tax too. So they end up having a huge tax bill. So there's a little bit of coronavirus relief here for people that pulled money out of their retirement account to help them get by. But you have to fit into one of these excuses, I guess I should say. So you were diagnosed with COVID-19 yourself. Spouse or dependent was diagnosed. Or you faced adverse financial consequences due to like quarantine or furlough or whatever, due to the COVID-19. You're unable to work. So what this does is this gets you out of that 10% penalty for pulling money out. How does this work? So you would have had to tell your financial advisor about your situation. And then when you get your 1099-R at the end of the year that says, hey, this guy pulled $100,000 out, it'll be coded with a 2 instead of a 1. So your tax preparer can put a 2 there, coronavirus relief, and you can actually pick that income up evenly over 3 years. So if it's $100,000, you'd pick up $33,333 in 2020, same in 2021, same in 2022. So you get to pick that up over the 3 years, which if you picked it up all in 2020, income tax brackets wise, you're probably paying a higher percentage on it. So it's a pretty good deal, actually. oh yeah, tax evenly over 3 years. You can pay the money back and then not have to pay tax on it, and also go back and amend your return and get the tax that you paid on it back. So let's say you took, how do we make this even? Let's say you took $90,000, okay, out in 2020. You needed something to help you get by. You're not hit with a 10% penalty, but you did have to pick up $30,000 of that income on your 2020 tax return and pay tax on it. Then in 2021, you have a better year and you're able to pay back all 90,000, let's say. So you would not have to then pick up the income on your 2021 or 2022 tax return, and you could go back and amend your 2020 tax return because you already paid tax on it and get that money back. You're limited to $100,000 there. If you went over that, you can't. You'd have to pick it all up in the same year. And one thing that's kind of odd here is you could potentially convert this to a Roth conversion. Some people are interested in doing this kind of thing. Generally, it takes a lot of planning to see if it even makes sense to do. But this kind of makes it easier. If you had coronavirus, if you were diagnosed with COVID-19, you could pull this money out. You could recognize the income over 3 years, and you could actually convert that to a Roth. So it's just a little tax planning option that's available.
We do have a question here. The Ira distribution, does this apply even if it is an inherited IRA?
I don't think so. No, I'm going to say no. I will double check on that. If that person that has that question wants to contact me after, I'll find out the answer. Okay.
I'm
Moving
going
on.
to interrupt you one last time. I missed a question. I apologize. There was one from, let's see. Sorry, I'm scrolling. Do you get to write off paying your CPA? And how do you know if you are overpaying the CPA?
Never overpaying. No, just kidding. Yes, if you're a business owner, then yes, you could write off the fees that you paid your accountant right on your Schedule C. If you're a small business and you report it all on your tax return, yeah, that's deductible on your Schedule C. If you are a corporation and you pay your accountant, yeah, same thing. You'd write it off there. If you're just an individual, then under the new tax law, I don't think that's even deductible, but it was subject to 2% of your adjusted gross income in the past anyway. So people rarely got that as, non-business taxpayers. But yeah, as a business person, yeah, you can. And how do you know you're overpaying? I guess, you shop around. When you're first looking for an accountant, try to find, shop around 2-3 different people. I think most importantly, you want to find somebody that's going to be, honest and that's going to work with you and get you the best tax savings that may be more important than cost. We've run this situations where we've taken over the accounting for people, and we look and we say, oh, your last person missed this, and then they didn't want to pay our fee, but we just saved them. In this case, it was like $80,000 in tax, and it was like, does it really, so it depends. But I'd probably reach out to firms and kind of see what the hourly rates are, and depending on what you got, it's different too. So you could ask around, ask your business friends what they pay. But if you find a reputable firm, generally speaking, the fees are going to be similar with other reputable firms.
And if you can go back one slide, there's a question on, is the Roth conversion only related to paying back?
No, the Roth conversion is, so if let's say you had an IRA and you pulled, let's say that scenario that I talked about, that $90,000 scenario, let's say you really wanted to convert this to a Roth, right? Because there's different benefits to these retirement plans. With a traditional IRA, you get the tax break as you contribute to it. So if you're putting in $6,000 per year, you get a tax write-off for that $6,000. Okay. But then when you pull the money out, you have to pay tax on it. A Roth IRA is you do not get that write-off as you're contributing. Let's say you're paying $6,000 every year, you're still paying tax on that $6,000, but as it accumulates over time and you pull it out when you're retired, all the earnings, all the contributions are tax-free. So some people want to convert from a traditional IRA to a Roth so they can start from that point growing it tax-free. Let's say you had $100,000 and then in 30 years, let's say you pull it out and it's worth $1 million. You're not paying any tax on that as you pay yourself distributions. So that's the reason why people do it. This gives you an opportunity to pull money out of the traditional IRA, which would generally be taxable the same year, split it over 3 years, and then put that $90,000 right into a Roth IRA. So it's just a way to do this conversion. Before anybody does anything like this, I'd recommend talking to a financial advisor, talking to a tax professional, because situations are different. You know, sometimes Roth makes sense, sometimes they don't. You have to understand that if you're paying more tax now because your income's higher, when you're retired, maybe you're not paying that much tax because your income's lower. So you have to run these different scenarios before you decide anything like that. But that's one thing that I found kind of odd, that you could just, hey, I had coronavirus, I pulled the money out, I'm recognizing over 3 years. Oh, but I threw it in a Roth IRA. So probably a little complex to understand without sitting down and talking about your personal situation with your advisor. Okay, required minimum distributions. This is something that if you're over the age of 70, you probably know what this is. So when you have a retirement account, they force you to take this money out because they want to collect their tax on this money. So for 2020, RMDs, as they call it, required minimum distribution, they're not mandatory. So hopefully by now, if you were receiving payments, you paid it all back. If you didn't want to take it, some people don't, because higher income taxpayers, they don't want to pay tax on it. They want to keep it in their retirement account. They had until August 31st to pay it back. May not apply to many people here. Figured I'd mention it. NOL carryback. So this is now allowed. It was eliminated under the Trump tax law, and they brought it back under the CARES Act. So you can actually, let's say you have a bad year in 2020 and your income's below zero, you could take that income and you could file a form 1139, I think it is, and you carry that loss back, and you can offset taxable years if you had bigger years in the past, or you can carry it forward, but it gives you an opportunity to carry it back and potentially get that money back that you paid in previous years. And something that's going to apply to pretty much everyone with the CARES Act, there was this charitable contributions deduction that was added above the line. So what that means is you don't even need to itemize anymore to take at least a $300 deduction, or max a $300 deduction on your tax return. So if you had cash contributions of $300, you'll get that deduction, you'll get your standard deduction, and it won't go to waste. A lot of, most people aren't itemizing nowadays with the new tax law. So at least you get some benefit out of contributing $300 to charity. Okay, so here's kind of the big one, the Payroll Protection Program. So we'll get into what this was first, and I think probably a lot of people here got it. I know the majority of our small business clients have received the PPP money. So this is a forgivable government loan that was specifically meant to be used to help the businesses get through this. Okay, so use it on payroll, use it on rent, use it on utilities. There were some other small expenses that you could use it on. And, it was paid out to, I think as long as you were in existence before February of this year, you were eligible. You had to fit some other criteria in order to get it. But at this point in the game, it's a little too late to get it. Although it looks like the new bill that they're creating here, they're putting more money into it. So I don't know what that'll mean. I guess we'll have to cross that bridge when we get there. But how was the loan determined? Well, it's different based on your entity type. So corps were, it was based on the prior year payroll, which you would have already had to submit all your information to the bank and get this loan and everything. self-employed people, it was actually a little bit different. It was based on your prior year profit. Okay, and this is an important difference here for potential taxability of this, which we'll get into. Before we get into that, though, we'll get into PPP forgiveness. Now, I'm sure a lot of you are going through this now, are wanting to go through this soon. You're working on it. Who knows? Maybe you already had it forgiven. We've had probably, 20 businesses maybe already apply for forgiveness. I don't think they've heard back yet from their bank, but we'll get into how you actually get this loan forgiven. But first of all, I wanted to say that this has been just a moving target, this whole thing. It's just been a big mess. Obviously, it was a crazy situation, but this was all jammed together. And it continues to be a moving target. So the covered period, and what I mean by that is the day that you receive your money, you had originally 8 weeks to spend this on qualified expenses, meaning payroll, rent, utilities, and some others. You had to spend that within 8 weeks in order to have it forgiven, essentially. Okay. We ran into situations with restaurants, with other clients that they couldn't get their employees to come back to work. So they weren't able to spend this money. It was going to turn into a loan. So I guess the lawmakers heard this and they improved this covered period or extended the covered period to 24 weeks instead of 8. And what we've seen now is that pretty much 100% of the businesses we're expecting, it's probably a little bit under 100, but the majority of small businesses are getting 100% of their loans forgiven, mainly on payroll. Originally, there was a requirement that you needed to spend at least 75% of this on payroll. And then they dropped the requirement a little bit to 60%. So if you do 24 weeks, you only have to spend 60% of this on payroll. So it made it a little bit easier to have it forgiven. Again, originally there was this FTE reduction clause in there. And by FTE, I mean full-time equivalent. So they look at your full-time equivalent before you got the loan, during your covered period, and during your covered period. And they would say, if that dropped, then you're going to owe some of this back. Now they got rid of that, as long as the loan recipient, you have to have it documented that you had an inability to hire or rehire employees, which has been a legitimate issue. Obviously, with that additional unemployment money of $600 plus the state money, people were making more money at home than they were at work. So a lot of our businesses were really struggling to get their people back. By the way, that $600, all that unemployment, if any of you guys received it, which I know small business owners were eligible, as long as you made under $506 a week, just be prepared to pay tax on that, because that is a pretty substantial amount of money. It's going to be a big shocker for a lot of people, I think, if they weren't having money withheld on that. Okay. So what form do you fill out to have these loans forgiven? So the latest thing that came out was this $50,000 and under. If your loan's $50,000 or under, there's a form called 3508S. And this form is very easy. You check a couple boxes, you send it in, and your loan is forgiven. Very fast. Probably don't need any professional help for it. Definitely good. What about other borrowers? Okay, so there's this 3508 easy. And this is for all people that received the loan that they didn't have to reduce their employees during this covered period at all. Even though it says easy, doesn't mean it's easy. This is not very straightforward, these forms. If you received it, I'd recommend, and you have employees, reach out to your payroll provider and see if they can print you off some reports. I know we have 3 different reports that really help fill out this application. So as you're filling it out, I'd recommend reaching out for help to your payroll people. Also, send this out to your accountant maybe if you want. I mean, yeah, they'll charge you a fee, but you want to make sure that this is right for reasons that I'll get into on the next slide. All other people, you got to fill out the 3508, the full form, and it's not fun, and it doesn't make a lot of sense. And there's all these different schedules. So you want to make sure that if you need help, you reach out for it.
Hey, Jim, we have a question.
Yep.
If you used your PPP loan as payroll for a sole proprietor, is it counted as taxable income?
I'll get into that.
Thanks.
Yep. PPP forgiveness continued. Okay. Why do you want to reach out to a professional to make sure that you're doing it right? I'd say probably unless you have that, what is it called? That N? Is it N? Let me see. I gotta go back here. Move that here. 3508S. Like I said, you have that, you're under $50,000. Do it yourself if you want. Check the boxes, send it in, you're fine. Otherwise, reach out, try to get professional help unless you're good with finance type stuff, because you only have one shot. All right, you send this in for forgiveness to your bank. Supposedly, it's approve or deny. And then if it's denied, it turns into a loan. 1% loan that you have to repay over 3 years. I'm not saying that to scare anybody. It's just the reality of what's being said out there. So make sure that you're filling it out right. And we haven't seen anybody get it rejected yet, but we haven't seen it approved yet. We're assuming they'll go through. Lastly, the point I want to make on this is chill out. So we have clients reaching out all the time. They're dying to get these things forgiven. You have 10, a lot of them aren't even, they just got out of their covered period of the 24 weeks. You have 10 months from the end of your covered period to apply for forgiveness for these loans. So it's not a rush. You want to make sure you get through that covered period. You want to make sure you fill out the application correctly. That is more important than speed. So don't freak out. There's plenty of time. You have until, the end of the covered period. Doesn't matter when you got it. Well, the latest possible date is 12/31. Most people is somewhere in November because they receive the money, I don't know, June, July, something like that. So take your time. Like I said, 10 months is a lot of time. Okay, taxability. We already had the question. It's really unknown at this moment. And that's from my perspective. The IRS knows what they want to do. They've made that clear. Okay, so the IRS is saying, I guess I'll start with Schedule C. Your Schedule C filer, the question was, is this taxable even? I spent it on payroll. No. That's one of the advantages of being a Schedule C in this scenario. This money is not taxable to you right now. It doesn't look that way. Okay, so if you're a corporation, it's different. So the IRS has come out and given guidance, which really shocked everybody because the intention of this was, it was even stated in the law that this is not taxable. But the IRS is treating this money as a grant. So they're saying all this money that you receive, yeah, you don't have to pick it up as income, but you can't write off the expenses that you paid with the money. In other words, it's taxable. They just kind of found this workaround to make this taxable. Now, we're hoping that there's more legislation for this in December because we know this is going to cause massive issues with our client base because everybody got it and the IRS is saying it's taxable. There's another position that potentially you could take saying, that's not the intent of the law. I'm writing off this stuff no matter what. And then I'll wait to be audited for one, or I'll wait for there to be a court decision on it, which I'm sure there will be. That's one thing that we're telling maybe our aggressive clients, but the IRS is not, they took their position on it and they're saying basically it's taxable. They also said, so one of our thoughts immediately as accountants, we're thinking, oh, how do we get around this? Okay. So one of our thoughts was, all right, well, we won't apply for forgiveness for this until 2021, so we don't have to pick this up as income in 2020. It gives us some time to do some tax planning, things like that. The IRS came out with guidance on that recently that says, nope, if you expect that this is going to be forgiven in full, you have to pick it up as income, or you can't write off the expenses in 2020. So we're hoping for more legislation on this in December. It's a wait and see. As I said, this is a moving target. One thing that I've been doing for my clients is providing tax plans for them in 2 different scenarios. Scenario 1 is, here's your business projected tax without the PPP money included, that's taxable. And then scenario 2 is, here's your business income, tax that you'd owe with PPP money included in there as taxable. So that if you're working with an accountant, I'd ask to see it both ways, just so you're prepared. As I said earlier, we're hoping for more legislation on it. The intent of the law was clearly stated that that it was not taxable. And the way we would fight this is we'd say, well, the IRS said it's a grant. It's not a grant, it's a loan. The law says that the loan, the forgiveness of the loan is not taxable. So it's not a grant, it's a loan. You'd normally get a cancellation of debt that you'd have to pick up as income. It was canceled. Law says it's not taxable, and we're writing off the expenses. This isn't a grant. So that's the argument for it. We'll see what they do. Also, there was talks of potentially auto forgiving any loans under 150,000, essentially the same as they did for 50, right? So you'd get that application and you'd be able to check a couple boxes, send it into the bank, get forgiven, or get your $149,000 loan forgiven essentially automatically. So we're hoping for that too. That's what we're hearing whisperings of, but nothing is guaranteed. Here we go. I was wondering what EIDL stood for. I knew it, but I wasn't sure of it. Economic Injury Disaster Loan. This is another one that was big. And as advisors, this all happened during tax season. We were advising our clients to apply for everything, get as much money as you can get right now, because we don't know what's going to happen in the future. So we have a lot of people that have applied for the EIDL loan. They got the PPP money, they got the EIDL advance or grant. So this one is a grant. So you got all this stuff. What do you do, right? So this grant is supposed to reduce your forgivable portion. So it's supposed to say, let's say you got a $50,000 PPP loan and a $10,000 EIDL grant. Supposedly, you're supposed to report this on your PPP loan forgiveness application, and you'd have to repay the 10 of it, and only 40 of that would be forgiven. But from what we've seen so far, this has not happened. The PPP has still been like all forgiven according to the application, and that EIDL is just listed there. So we'll see what happens there. But again, is this taxable? We're waiting for more guidance. On this one, I would guess that yes, it would be, because this one was kind of presented as, all right, this is an advanced grant. You're not going to have to pay this back no matter what. The PPP one, though, is a little bit different. So I'm saying right now, I think this one will be taxable, but who knows? Who knows what will happen? Wait for more guidance, and we'll see. But plan it both ways. Okay, so there are some other stimulus options available. Payroll credits. This was for if you had employees that were taking sick leave or paid family leave during the COVID crisis. You are able to take you were able to take a credit on this stuff. So it was sick leave. You were able, if you paid it out, you were able to take a credit on your payroll reports, payroll returns that should already have been filed. So it could be too late if you didn't do it yet. It's pretty much running out at the end of the year. So you had up to $511 on sick leave, and then for the child care leave, it was up to $200 per day that you'd report this on your 941, I think it was. And if you receive these credits, these are included in your income. The employee retention credit. So this one is only eligible if you didn't receive the PPP money. And again, this was on your quarterly payroll returns. But this one is kind of, there's limitations to this. So there's revenue limitations. If you could only do it if you dropped like 50% of your revenue. You have to look into the specific rules and your specific situation. But again, this is one that's like expiring in December, so it's not something that you file on your normal tax return. It's on your payroll returns. And yeah, so these expire 12/31, as I said. And that's actually all I have for this presentation. Does anybody have any other questions regarding tax planning, regarding CARES Act, or any other miscellaneous entity or tax questions that you'd like to ask? We're about 8 minutes short here.
Somebody mentioned a comment. It says, not a question, just an FYI. I submitted our PPP forgiveness via our bank, and they submitted it to the SBA. The SBA said it can take 90 days for an answer, i.e. forgiveness approval or denial.
Mm-hmm. Yeah, and something else that I'll say on this is it's all, the timeline for this is different depending on your bank. So be patient. The banks are rolling out these different platforms. Some they're sending, you know, the same bank may send a forgiveness application to one company before another. But you just got to kind of wait it out a little bit here. And, you know, when you get the application, that's when you could start working on it. But as I said, it's not a rush. You got 10 months here to work with. And thanks for the FYI. That's good information.
And I do want to remind people that the YouTube link of the presentation will be emailed to the registrants as quickly as we can. And I did post in the chat a link for the Business Insights Center page at the library, as well as make an appointment if anybody needs that information. Okay, so we've got a question. Let's see. I'm a single member LLC. My accountant didn't reach out to me all year about the PPP, EIDL, etc. Should they have reached out to clients, and should they be replaced?
It was tough to reach out to everyone. So this happened during tax season, and I don't know about other accountants, but I'm working 70, 80 hours a week during tax season. And then this got dropped on us. So it was tough to reach out to everybody individually. We did a lot of e-blast kind of stuff. We sent out letters letting our clients know what was available. But if you didn't get anything like that, I would at least ask the question of why. Maybe it's it could be your accountant is kind of like a one-man shop, and it's tough to, you know, it's tough to contact everybody, and they don't have the department to send out all this stuff. He or she maybe was grinding through tax returns, and I don't know. I wouldn't base your decision of moving accountants solely on that. But what we did was send out e-blasts and newsletters and things showing what's available.
Okay, another one. If you received a grant from the EIDL, which PPP tax filing should be used? I wasn't eligible for PPP loans, i.e. I'm a new business.
So they received the EIDL. You don't need to apply for PPP forgiveness if you have the EIDL. If it was just the advanced grant that you received, then you don't have to repay that. So there should be nothing else you have to do. But if you receive the EIDL loan, then yeah, you're gonna have to, that's actually a loan that you're gonna have to repay. But you don't have to file anything with the PPP.
And how has the IRS given a timeline on when they were giving an approval on the taxability of the PPP?
IRS has nothing to do with it. IRS is saying it's taxable, basically. We're waiting on Congress to create legislation to correct the IRS in their position and make it non-taxable, basically. we're hoping that, I think they're in session now here. So we're hoping something gets done in December. But we'll see. I mean, there's things that have happened in the new year, you know, with other tax issues, they correct things after the fact. For some of this stuff, they just correct years after the fact. So it's kind of a guessing game, but hopefully this is a big issue. Hopefully they do something in December.
Jim, we have a request for your email. Do you have an email address you can give to people?
Yeah, it's J, and then my last name, it's S as in Sam, WIECH at alliedfp.com. That's ALLIED, F as in Frank, P as in Paul.com.
Thank you.
Yep.
Is there going to be any tax credits for the kids not being in school?
No, not that I, nothing additional that I've seen yet. Nothing with the CARES Act. Not unless they create that into some new sort of this new stimulus package or whatever. I don't know what they'll do. Who knows what they'll do? But so far, nothing like that. Oh, are you saying like children? I was thinking college kids. There was just that. If you're an employee, there was that. If you took time off, you paid an employee to take time off because the schools were closed. Then you could have, as an employer, taken a credit, but nothing for people. No break on your real estate taxes or school taxes or anything like that, unfortunately. I know a lot of parents are playing teacher nowadays. Luckily, my wife is a stay-at-home mom. She was a teacher too, so even though my kids are going to school every day, but it's tough for sure.
Any other questions out there?
Yeah, so everybody has my email. If you feel free, if you have any questions, just shoot me a quick email. I have no problem just shooting a response quick. Otherwise, I guess we'll keep monitoring what's going on with this PPP stuff. I know a lot of us are very anxious about it. So we'll see what happens.
Jim, thank you very, very much. Extremely useful information. And Tim, I think you wanted to say a few words, or was it Jan?
Kate, I'll speak up. This is Jan Pazanchen, Small Business Development Center. Thanks again for a great program. Jim, great information. Looking forward to next month as well. There will be we'll call it a part 2 in January for first Wednesday on this topic, get you started properly for the new year. And hopefully by then we'll have some more clarification on these COVID-related loans. Also, just a reminder to everybody, questions came up. Should I have known about this? Should somebody have told me about this? If you could get onto our email list, which is very simple, just shoot us an email and say we want to be on your email distribution list. We'll keep you informed, as we have right from the beginning, on the various programs that exist and how to apply for this. And if you're looking for assistance with putting your information together, especially on the financial end of things, we can help with that as well. So I'm sure Jim and his firm and other accounting firms out there as well. So there is help available. You don't need to ride this out alone. If you're looking to just make sure you get your ducks in order for the new year with the new business plan, marketing plan, again, we can help you with that. Our contact information I posted in the chat box as well. So you have our email address, phone number, and also our webpage to schedule an appointment. And just a reminder, folks, at the end of this, you will be receiving a survey about the program. We greatly appreciate any feedback you can give us, any insights that you can give us, and any requests for future programs as far as other workshops. We have a great partnership with the library. We're looking forward to keep that going. And the best way to do that is to present information and programs that are of interest and importance to you. So please keep us advised. Thanks.
Thank you.
All right. Thank you all for coming, and have a wonderful day.
Hey, bye-bye.
Thank you very much.